Hello, it's Jordan, and this video commentary is being recorded on the late evening of Thursday, April 29th, 2021. Thank you for joining me. If you're watching this on YouTube, please like, comment, and subscribe. And in this commentary, I am going to discuss the three major ways how junior companies can add value, and I'm going to go into some detail on each. And I think this is important and helpful right now because we're in a time in the market with respect to precious metals where I don't see a strong risk of a big move to the upside or a big breakout move in the sector anytime soon. I mean, I could be wrong about that, but that's my view right now. And so I think it's important to step back and do more research on companies and really drill down on which companies have the potential to really explode in value over the next couple of years as we see precious metals trade much, much higher ultimately. So first, I'll just go over the three ways that a junior can add value. For exploration companies, it's either making a new discovery or growing an existing discovery. For development companies, it's basically building the mine and successfully doing it without many problems on the financing side or the actual construction side. And then for junior producers, it's growing your production. So those are the three ways. Now, I'm going to drill down a bit on each way. And so starting with exploration companies, so you can make a new discovery or grow an existing discovery. Now, I prefer the latter. I think the odds of success are better if you're looking at something where there's already a resource, there's already some discovery, and you're trying to identify which of those have potential to grow significantly in size and scope. Whereas because I think the odds of a virgin discovery or discovery happening just from virgin ground is just way more unpredictable. It's way more difficult versus something that's already existing. The odds of that are better that existing discovery has upside potential, at least in my experience. So that's why I focus on looking at existing deposits and discoveries and trying to identify which of those can get a lot bigger and therefore become a lot more valuable to the industry. And so, I mean, it comes down to, you have to look at maps. You have to know how to interpret drill results. You have to talk to people. And so I have sources in the industry that I consult with that help me out on the things that I don't know. So those are some of the things that you have to do. You really have to do your research. And then, and this is really important, is you have to evaluate the potential mining scenario. And I know this is difficult when you're in the exploration stage, but it's important because ultimately that's what the market's thinking about. The things that do really well, that make a big move and where it's really sustainable and it keeps moving and growing in value, it's something where the market sees, yes, this has potential to be a mine. This is going to be a high margin project. It's going to be not too expensive to build. It's going to have great margins, and therefore someone's probably going to buy it. So, evaluating the potential mining scenario, that's really important. And so if something's growing in size and it looks like it's a good discovery, but this stock isn't doing as well as you think, there could be other issues there. It could be that the potential mining scenario isn't really there, or isn't what it needs to be for the market to really like that project. So moving on to developers, and I've done a video on developers in the past, and so obviously it's building a mine successfully, and so this is where the valuation really comes into play. So you have to look at economic studies, look at the net present value at various gold prices, and then look at where the company is being valued at. You have to do some calculations here, but it's so important. And so I like to look for things that are, maybe they're trading at like 0.20 times net asset value or 0.15. Because if you're looking at things in that range, if those things can get financed and then you have a great team behind them, they're likely to get built. And then if they're built successfully, you have a lot of upside potential there, because then, depending on the project, it can trade up to 1 times net asset value, or, zero point 0.8 or 0.9. And so that's huge upside with the increase in valuation. That's not even factoring in a rise in metals prices. So those are the types of things I like to look at versus, if you see things that are already trading at, 0.5 or 0.6 or 0.7, they're not going to have as much upside potential when the project actually gets built. And another important thing is, timing is obviously important. You have to look at the development curve. And, for me, I think it's like sometime within 3 or 6 months of the first gold being poured, that's when the stock will start to outperform. So timing is also important, but, you might be able to get the best value if you buy a year, 18 months in advance. So you have to keep those things in mind. And then lastly, is there upside beyond the initial plan? Because if, the company can build the mine in a phased approach, or there is potential for them to, after it gets built, they can expand it because of exploration or because metals prices move higher. That's also really significant. That gives you additional upside. That's growth, which leads into producers. And it's all about production growth. The market loves growth in any sector, any industry. And so you have to look at, what's the cost to achieve that growth, how they're going to finance it. And, you have to look at the development projects that a company has in the pipeline. How feasible is it that they're going to be able to bring this project on board? Is it going to take 3 or 4 years? That's too long. Could it only take 2 years? That gets into the timeline. And to give an example, look at Roxgold and their Seguela project. The stock was really outperforming in the last couple months. And so the market, it was anticipating the study that they just put out. I know they just got acquired. That's a whole nother conversation. But the stock has been outperforming the sector. And so the market was starting to discount and recognize they have this other project in the pipeline, and they're going to be able to build it soon. It has really good economics, etc. So that's just an example of things you want to look for. And then obviously exploration is huge. If you look at some of the biggest winners in the last 3 or 4 years, think about Kirkland Lake, the exploration success they had. Wesdome was another one. I know that stock has corrected a lot. K92 Mining is another one. So existing mines, if companies can find a lot more gold or much higher grade gold around an existing mine, they already have the infrastructure there. That is a hugely positive catalyst. There's a company I don't own, it's on my watch list, but I noticed they drilled a hole below one of their existing mines, and they just had some just sensational drill results. It's an existing junior producer. That doesn't mean that you have to run out and buy the stock immediately, but it's just something you have to file away, or you make a note about it and let yourself know. This is this could be a situation where exploration at some point in the next year or two really adds to this company's value. So those are all the things I'm looking for. And I think this is a good time to do a lot more focused research on these companies, and that's what I'm trying to do. And so I hope you found this commentary informative. Thank you so much for tuning in, and you can follow all my work at TheDailyGold.com. Thank you, and I look forward to doing another update for you guys in the days and weeks ahead.